Good morning, everyone. Thanks for joining us. For those of you that don't know me, my name is Amanda Adams, and I am the National Leader of Nonprofit Tax Services at Cherry Bekaert, and I'm in our Atlanta office. So today I'm excited to talk about unrelated business income that has nothing to do with providing parking to employees. That's kind of been the hot topic, of course, over the past year, but we have to remember that unrelated business income can come from many other sources. So today we're going to do a deeper dive on UBTI from debt financed property, advertising, and rental activities. And then we're also going to spend a little time just talking about the importance and some ideas around how to identify direct expenses and potential methods for allocating indirect expenses with respect to UBTI activities. So just to recap briefly before we get started, the main concepts of unrelated business income is first you have to take a three-prong approach. If not all of the three prongs are met, then generally you will not have unrelated business taxable income. The first concept is that the activity has to be an active trade or business. So it has to be a business-like activity. Second, it has to be an activity that's not related to your exempt purposes. If it's related, then it wouldn't be UBTI. And then the last piece is that the activity has to be regularly carried on. Now, there are some caveats to that, of course. There's always a general rule in tax, but then there are exceptions and exclusions and variations. So while those three prongs may be applicable, there may be some types of revenue that are excluded by modification. So they're specifically listed as not counting as UBTI if they meet certain criteria. And then some of those criteria that exclude items from unrelated business income, if it comes from debt financed property, as we're getting ready to talk about, then it is added back to UBTI. And then there are numerous exceptions, based on, things that have just been written into the law over the years, such as the exclusion that's provided for selling donated items. So first, let's take a look at debt financed property, and let's define what debt financed property is. So first, it must be property held for the production of income. So that makes sense because we wouldn't be concerned about potentially having UBTI if the property didn't generate income. But it has to have that intentional purpose of being held for the production of income. Second, the property has to be subject to acquisition indebtedness, which again has a very specific definition that we're going to go into, at any time during the taxable year. So if the property that was generating income was subject to acquisition indebtedness at any time during the year, then it will be included in the definition of debt financed property. Now, let's say you don't meet that because there was no debt at any time during the year, but there was debt within a 12-month period prior to the disposition of the property, then that is another way that you will need to meet, or you will meet the debt financed property definition. So if the property is sold and you have capital gain from it during the year, and there was debt at some time in the past 12 months prior to sale, then it will be deemed debt financed property for purposes of calculating UBTI from the sale. So acquisition indebtedness is indebtedness that is incurred in acquiring or improving the property. So if an office building is purchased with a mortgage, then that would be acquisition indebtedness. If the office building is not purchased with a mortgage, but later on is renovated for the purpose of improving the entire building or just the part that may be rented out, then that would also be acquisition indebtedness because it relates to improving the property. Indebtedness incurred before the acquisition or improvement can also be acquisition indebtedness if the debt would not have been incurred but for such acquisition or improvement. And similarly, indebtedness incurred after the acquisition or improvement, if that indebtedness would not have been incurred otherwise, and it was reasonably foreseeable that the debt would need to be incurred, can also count. So I think this is kind of a way to get around loopholes that people might have taken advantage of in the past by not literally incurring the debt at the time the property was acquired or improved, but they really did need debt to do that. They just kind of manipulated things so that they borrowed the money in an earlier or later time. So the IRS is trying to close the loophole on that by saying if it's connected to the property and wouldn't have been done otherwise, then it is still going to count as acquisition indebtedness. So the first exception we're going to talk about is for donated properties. So if property subject to a mortgage is acquired by an organization either by gift or bequest, then the indebtedness will not be treated as acquisition indebtedness. There are a little bit different rules depending on whether it's a bequest or a gift. If it's a bequest, then for 10 years following the date of acquisition by the exempt organization, any debt will not be counted as acquisition indebtedness. For the same to be true for a gift, there are two things that have to be in place as well, which is that the property has to have been held by the donor for more than 5 years prior to the gift, and the mortgage has to have also been placed on the property more than 5 years before the gift. And the organization cannot assume or agree to pay the indebtedness. So kind of for that to work, the donor in contributing the indebted property would have to continue to pay that mortgage, and the charity would not be able to kind of assume that as part of the gift and pay it. If they did, then the acquisition indebtedness rules would apply. And if there was income generated from the property, if there was not another exception that would be met, then it would be UBTI. There are a number of exceptions that are related to the type of debt that is on the property. One helpful one is that if there is existing debt that has been around for some time and merely a renewal or extension or refinancing of the debt, that will not be treated as creation of new indebtedness. So if it's refinanced and you have an acquisition or improvement at that time, it will not be connected to that acquisition or improvement if it's based on a pre-existing debt. And also, debt that is part of the organization's exempt activities, and it's just an inherent part of that activity, like when a credit union accepts deposits from its members, that's not going to be treated as acquisition indebtedness. Sometimes organizations may accept gifts that create charitable annuities, and there are some specific criteria around that would cause it not to be indebtedness as well, depending on a ratio of the gift to how much will be paid out, et cetera. So if that is something that relates to you, you might want to look a little deeper into that. There's also an exception for funding insured by the Federal Housing Administration related to low-income housing. So that could be, useful in certain situations. Another one that kind of comes up from time to time is when you have a group of related organizations, like a title holding company or a supporting organization that was formed to hold real estate on behalf of another organization. There might be some loans in between those related organizations with respect to, the property or other items. And so for this purpose, if the loan is from a related organization, it's not going to count as acquisition indebtedness because it's not deemed to be true debt when it's between related organizations. So next, let's talk about some exclusions that are based on the current usage of the property that might have debt on it. The first exclusion is when the property is substantially used for exempt purposes, then any incidental usage that generates income that might be taxed as UBTI under this provision is excluded. So we'll talk a little bit more in a minute about what it means to be substantially used for exempt purposes. It might be common sense, but if the income is already treated as unrelated business taxable income under another provision, then there won't be a duplication of that under this provision if there's also debt connected to the property. And then there are three related exceptions which have to do with the income being excluded under another provision, either for research, that's for educational institutions or on behalf of the general public or governmental entities, or if the income is from an activity that is substantially carried on by volunteers or for the convenience of members, students, etc. If the property that is used in that activity is indebted, then it will not be treated as debt finance property for this purpose because the activity itself is specifically excluded. And then lastly, if property is used by a related organization in its exempt purposes, but the charity that holds the property and holds the debt, they will not have to worry about treating any income from that property as being taxable as long as the related organization is using it for those exempt purposes. So it's good to know that when we have affiliated organizations and loans and property kind of used by different members of the group, that it all can be taken into account with respect to the related usage of the property. So substantially related usage is generally interpreted as 85% or more. There are many places in the code where the term substantially all or substantially related come up, and that has generally been interpreted as 85% or more, but it is based on facts and circumstances, so it's not completely set in stone. Factors that you would consider would be not only the portion of time that the property is used for exempt purposes, but also the portion of property that's used for exempt purposes. So, for example, if you have an office space that the organization is using and they have a ballroom, and sometimes they rent out the ballroom, you would want to take into account, not only the square footage that is being used for unrelated purposes, but also the time, how many days in the year, or even how many hours sometimes for certain organizations is the property being used for related versus unrelated purposes. So you may sometimes need a combination of both factors in order to come up with that percentage. There's also an exclusion that is based on future usage. So if an organization acquires property that is in the neighborhood of property that it is already using for exempt purposes, with the intention that they will use that land within 10 years for exempt purposes, then there will be an exclusion, but there are a couple of caveats. One, the land generally has to be in the neighborhood of other property. And then if the property includes land and a building or other structure, then if there's going to be any income generated by the building or structure, then that income would only be excluded under this provision if the structure is going to be demolished as part of the plans of the organization in getting the property ready for its future use. There also couldn't be a new construction of a building and rental of that building. That also would not fall under this exclusion. Churches have an extra benefit with respect to this rule in that their time frame is longer. It's 15 years instead of 10. And the land doesn't have to meet the neighborhood test. So it doesn't have to be, nearby any existing exempt purpose land. So you may be wondering, what is the definition of neighborhood? How close does the land have to be? Sometimes people that are in urban areas can find it difficult to get land that is contiguous to their existing property. But while there is a fairly strict definition of neighborhood for this purpose, there is one little exception that could expand the definition somewhat. But generally speaking, property will be considered in the neighborhood of property owned and used by the organization if it is contiguous with existing exempt purpose property or would be contiguous except a road or stream or similar type item is in between the two pieces of property. But if it is still within a mile and not necessarily contiguous, if the facts and circumstances of the situation make the acquisition of property that is contiguous unreasonable, then you can kind of expand out to that larger margin. So in the example, they mention a university trying to get land contiguous to their present campus, but any properties that are nearby are not available for sale or are being sold at unreasonable prices. If they can still find land that is within a mile, then that would be considered neighborhood land under the kind of unreasonable exception provision. Another exclusion that is available for specific entities with respect to real property, it's a nice provision. Schools hopefully are aware of this, because it is a very generous provision with respect to not only schools but also their supporting organizations. So this exclusion does only apply to real property. So if there were investments purchased on margin or something like that, that wouldn't fall under this exclusion. Other qualified entities include qualified 401 trusts, 501c25 organization, which is a type of title holding organization. So essentially its purpose is to hold property on behalf of a related 501c organization, and also 403b9 retirement income accounts. So if the real property is owned through a partnership, and so what the qualified entity actually owns is a partnership interest that owns real property, then it still can fall under this exclusion if one of three criteria is met. So the first option is that all partners of the partnership are qualified organizations. So they would all have to be entity types listed on the previous slide that are qualified entities. If that isn't met, then the second possibility is that each allocation to a partner of the partnership, which is a qualified organization, is a qualified allocation. And what that means is that the percentage does not change over time. So if they have a 2% interest in income, expenses, and capital, then the entire time they hold the partnership interest, it's 2%. And of course, assuming that that allocation has substantial economic effect. So if the percentage does not stay stable, as sometimes some partnerships will base income and loss allocations on specifically stipulated cash distribution projections that might be based on what the net income of the partnership is. And so, the cash distributions vary over time, or they're set. And so the allocation of income and loss is just related to how much cash each partner receives. So there isn't a set percentage from year to year. That still can qualify under this exception if they can meet what's commonly known as the fractions rule, which basically means that the qualified organization partner could never receive a higher share of the overall partnership's income than it ever received of the partnership's loss. So again, there's kind of a focus on not inappropriately shifting income to the tax-exempt partner and losses to the taxable partners. So that's kind of complicated, but if you found yourself in that situation, you'd want to take a close look at those rules, because before you enter into the partnership agreement, you could have some ability to make sure that the partnership agreement complies with those provisions. So let's say we go through all the steps and we determine that none of the exclusions apply, that we do have debt financed property. The calculation is not that 100% of the income is UBTI. It's a percentage of it, and the percentage that becomes UBTI is based on the ratio of the average debt, the average acquisition indebtedness with respect to the property, over the average basis of the property during the tax year. Then we multiply that ratio by the net income from the property to arrive at the taxable unrelated business income. So the average debt is calculated by looking at the amount of debt on the first day of each calendar month during the tax year that the property is held. So that is important to note, that if the property is not held for the entire tax year, you're still calculating your average debt only from the time that the property was acquired. So you wouldn't be able to take into account months during the year when you didn't own the property and didn't have debt. So while the average debt is on a monthly basis, the average basis is only an average of two numbers, which is the adjusted basis as of the first day during the tax year that the organization holds the property, and the adjusted basis as of the last day during the tax year that the organization holds the property. So again, by adjusted basis, they mean after accumulated depreciation. These rules are slightly different when what the calculation pertains to is the capital gain from the disposition of the property. Because you may recall that I mentioned that, one of the provisions was even if there was not acquisition indebtedness during the tax year, if there was acquisition indebtedness at some time in the 12 months prior to the sale, then it would still apply. So for this purpose, rather than using the average debt in the numerator, instead, what must be used is the highest amount of debt during the 12 months prior to the sale. And again, this is kind of like closing a loophole of, paying off the debt right before the tax year begins and then selling it and then, not having any average debt, but still really there was debt closely connected to the time frame of the property being sold. So some tips to consider, if you might encounter this issue would be, if you have an opportunity to place debt on non-income producing property rather than income producing property, that would be a preferable option because then you wouldn't have to worry about picking up any unrelated business taxable income. Also looking at whether you can meet the substantially all exempt purpose test and then potentially putting debt on that property or, trying to kind of monitor the usage of the organization's property for unrelated purposes, trying to meet that substantially all test, just making sure that you always keep the usage at, 15% or below. And of course, when there's a sale, then you would want to try to make sure that that debt could be paid off, more than 12 months prior to the sale to try to make sure that you don't have to pick up the gain on that. Okay, so we have come to our first poll question, which is I would like to find out a little bit more about you and want to know how much this debt finance property discussion might be relevant to you. So does your organization have debt finance property that generates income? So first option is yes, a building. Second option is yes, investments purchased on margin. And last option is no. Okay, so we're going to give you a few more seconds to get through and answer that poll before we share the results.
And we also have a few questions in the questions pod. I'm not sure if you see those. We can.
Okay. All right. So it looks like the first question is for debt finance property and the purpose of producing income requirement. If the main purpose to acquire the property was to serve our client base, not to make a profit, does this still fit into the category and thus UBI? So I think, there's not a specific exception related to the intention when the property was acquired. But I think if you look at what the current usage is and you meet the substantially all test, meaning that 85% or more of the property is used for your exempt purposes, then I think you would meet that exclusion. Next question is, do the exclusions override the debt financed rules, such as rental income from the parking lot of the church? So that's a good question, and actually we're going to talk a little bit more about rental activities later, so I will save the question for that. Chrissy, can you go ahead and show us the results of the poll? I think we've got many people that have completed. Okay. Are we showing the results?
Yep, we are. They should be able to see the results.
All right. So it looks like 63% of you do not have any kind of income from debt finance property. And the majority of the people that do, it is from a building, which makes sense. Very infrequently have I seen people engaged in investing activities where they're buying securities on margin, but it does happen from time to time. So somebody had a question about what that is, and that is you can set up certain investment accounts where you have a line of credit, so you don't actually put money into the account, but you have a certain amount of money that you can borrow, and you will just use that line of credit to buy and sell investments. And sometimes, people don't do that directly, but a lot of times when you're invested in a partnership, the partnership itself may borrow money to acquire investments. And so when you get your Schedule K-1 that's disclosing UBTI to you, some of that may be from the debt-financed investments where they borrowed money. Okay. Let's move on to our second topic, which is UBTI from advertising. So advertising has a very specific definition for this purpose, and essentially it's any message or other programming material which promotes or markets any trade or business or any service, facility, or product. Advertising includes messages containing qualitative or comparative language like Bob's Burgers are the best burgers, price information or other indications of savings or value, which would be ABC Furniture will give you the best price. If there's an endorsement, meaning that the organization says we approve of the products of this organization, or an inducement to purchase, sell, or use any company's service, facility, or product. So if a message includes advertising and also an acknowledgement of a sponsorship, which we'll talk about a little bit more, then it will be deemed to be advertising. So if there's any advertising in the message, then that will be, the way that the message is construed, advertising. There are a couple of exceptions. The one that we're really going to talk about the most is for qualified sponsorship payments, because that's generally where we see these kinds of things. You have somebody sponsor an event of the organization, and as part of that sponsorship, they receive certain benefits, including, ads or acknowledgments. But it's always important to remember that the frequency of the activity, the regularity of it, is a common exception that can be used as well. So when an organization has a fundraising event, and whether they have a program or maybe it's just a little handout where they acknowledge the sponsors of the event, that is not a regular enough activity to create taxable advertising, even if the content of the message really is advertising. But if an organization has a monthly magazine that they put out and they're putting those messages in the magazine, that is a regularly carried on activity. So we would have to look at whether the qualified sponsorship rules could potentially be applicable. So a qualified sponsorship is any payment by any person engaged in a trade or business with respect to which there is no arrangement or expectation that the person will receive any substantial return benefit. And a substantial return benefit will be deemed to not have been provided when acknowledgments are provided. That's not advertising, but an acknowledgement. And the aggregate fair market value of all other benefits, including advertising, but there are some other things that could be included as well. If the fair market value of those benefits is less than 2% of the sponsorship payment, then it's deemed to be de minimis, and so it can be disregarded. So the important thing to keep in mind is what it takes to qualify as an acknowledgement. And so an acknowledgement includes exclusive sponsorship arrangements. So saying, Delta Airlines is the exclusive sponsor of the organization's golf tournament. If you just put on your website or your program logos and slogans of the sponsor that do not contain qualitative or comparative descriptions, if you just put sort of neutral information like a list of their locations or their telephone number or website address, and you have value neutral descriptions, or you simply display their products, either visually in the magazine or actually in person at an event, then all of those are deemed to be acknowledgments, not advertising. Another important thing to consider is that certain logos or slogans that may contain something that is questionable in terms of, being a qualitative descriptor. If it's an established part of their brand identity, then it will still be deemed to be an acknowledgement. Aside from advertising, other benefits that might be provided could include an exclusive provider arrangement. So that is different from exclusive sponsor. So allowing somebody to be the only sponsor of something is deemed to not have a benefit. But if they are the only provider that is allowed at an event or at the facility of the organization, then that is deemed to have a value, and so you would have to quantify it. Other types of goods or services might be included, like, there may be a special party to celebrate certain sponsorship levels. They might receive a certain number of tickets to the organization's event. And then the last kind of common benefit we see has to do with using the organization's intellectual property. So it might be the right to use their name or logo in connection with some of their business activities, where they might be using that to increase sales of some kind. So our first example, in an art museum organizes an exhibition and receives a large payment from a corporate sponsor to help fund the exhibition, and recognizes their support by using their name and logo in materials publicizing the exhibition, and also hosts a dinner for the corporation's executives. The fair market value of the dinner exceeds 2% of the payment. However, the use of the name and logo in connection with the exhibition is deemed to be an acknowledgement, so it doesn't have to be valued. So when there is when there's an excess over the threshold of the 2%, then what happens is the difference between the payment and the value of benefits received is treated as a contribution, essentially. And then the fair market value of the benefits received would be, exchange, transaction revenue. So it's not automatically UBTI, those benefits, but you would have to see if some exception applied. Either the revenue is in connection with an exempt activity of the organization, or if it's like an irregularly carried on activity, then it would be excluded under that provision. Next example, M, a local charity organizes a marathon and walkathon at which it serves drinks and other refreshments to participants at no charge. Those drinks and refreshments were provided by a national corporation, which also gives them prizes to be awarded. So M recognizes the support from the corporation by listing their name in flyers and advertisements and on the T-shirts that are worn by the participants. M even names the event to include the name of the sponsor. So all of those items are deemed to be acknowledgments. None of them create taxable advertising. This one's kind of a long example, so I'm not going to, read through it. You can look at it, on your own. This example is focused mainly on two things. One is that in this example, they've given both acknowledgments and also advertising. And so the acknowledgments are not quantified, and all of the benefits that are being provided fall under the 2% threshold. This example brings up another important thing to consider, which is when payments are based on either the number of people that are attending the event or the ratings of an event or some kind of specific numbers game, then there is the potential for a benefit being provided, a substantial return benefit, because you are trying to increase an activity that would benefit that sponsor. But just having them make the payment contingent on the event happening is not deemed to be a substantial return benefit. So you would need to, if there were any kind of contingency provisions in the arrangement, you would need to make sure that it wasn't something that was based on attendees or ratings if it's something that's shown on TV. In this example, we have two different types of arrangements, one which generates an acknowledgement and one which generates a benefit. So in this example, a college is naming a writing competition after its sponsor, and it's also allowing that sponsor to be the exclusive provider of all soft drinks on campus. So the use of their name in the competition is just an acknowledgement, but the right to be the exclusive provider of products on campus has to be valued. And in this example, it states that the right to do that exceeds 2%. In reality, I think it is difficult to quantify that. That's probably the most challenging thing with exclusive provider arrangements, is coming up with what the value of that benefit is. So let's talk a little bit about how the taxable advertising income from a periodical is calculated. Essentially, if you are, putting out a periodical as part of your exempt activities, like a magazine that goes to members, that really the purpose of it is to have to share information about the activities or have educational, material in some way, then because that is an exploitation of an exempt activity, there's a special provision that allows you to take any excess costs you might have from the exempt part of the activity and reduce the taxable income from the unrelated part of the activity. Only to zero, though, not below zero. So you can't generate a net operating loss from the exempt part of the activity. So we're going to go a little bit into what excess readership costs are, and that's basically the excess costs from the exempt portion of the activity. So what you would do is take a look at all of the costs of putting out the periodical, less any direct advertising costs that were included. And then when you take those expenses and you reduce any related income from the periodical, which is called circulation income, which is basically any non-advertising revenue like paid subscriptions, or if there's no specific charge for the periodical, but members who pay dues receive the periodical as part of their membership, then you have to allocate a portion of the membership dues to be able to know how much you have in terms of excess expenses that could offset that advertising income. So if the organization has those membership receipts that they need to allocate, there are three methods by which they can do that. First, if at least 20% of the periodical's total circulation is sales to non-members, then you would use the price that you charge those non-members. So essentially, whatever that price is times how many periodicals are distributed. If you don't meet that, but at least 20% of the members pay lower dues than other members because they don't get the periodical, then the price of the periodical will be deemed to be the difference between those two levels of membership. In my experience, that usually neither of those apply, and so we're in the last category, which is where you look at what the expenses are of the exempt activities of the organization, and you prorate basically a percentage of the expenses based on what the expenses are to create the periodical. And that's the numerator, and then the denominator is the total exempt activities. And so then when you multiply that by the membership dues, you're coming up with kind of an allocation of the membership dues revenue to the periodical based on the proportion of expenses the periodical bears to the total exempt activity expenses. And if the advertising comes from something other than a periodical, like maybe you might be holding an educational conference and you have advertising on the materials that are there, signage at the events, or on the organization's website. If the advertising activity exploits an exempt activity, your calculations will be very similar to the periodical one. But if it's advertising that's on a standalone basis, then you'll just be looking at the expenses related to that advertising activity alone. There won't be any additional expenses that you can take into account. So some tips with respect to trying to minimize the taxable income from advertising. What I've seen some organizations do is they just restrict any verbiage that is allowed when selling ads to what would meet the acknowledgement requirements. So they don't allow any of that qualitative or comparative language in any advertising that they put in their materials. If the organization has, kind of larger sponsorship levels, they might consider, trying to keep the value of benefits provided to sponsors below, the 2% threshold, so that if they are, providing advertising as part of that, they could escape the UBTI treatment under the 2% threshold rule. Or if, you have a periodical that, is kind of expensive with respect to the income that comes from it, and you want to sell advertising to try to help defray some of those costs, you could try to limit your net advertising revenue to the amount of excess readership costs that you would be able to use to offset it so that you wouldn't have taxable income. Okay, that brings us to our second poll, which is, does your organization provide advertising or acknowledgments for sponsors? And if so, is it in the organization's newsletters, programs, magazines? Is it on the organization's website? Is it on signage at events put on by the organization? Or is it some combination of the above? Okay. Looks like we've got quite a few people responding so far. And almost 50% of you stated that some combination of the above, and only about 30% are saying that there is no advertising or acknowledgement. So let's go ahead and close the poll and publish those results. I'm not really surprised by that. Many times it's something that is done that is not even really thought of as a specific benefit. A lot of organizations will have a list of sponsors on their website. So it may not even be something that you're thinking of as being, advertising or some kind of benefit to them. Okay. So now let's dive into UBTI from rental activities. So the general exclusion from UBTI for rental activities includes rents from real property, so land and building, and incidental, which is defined as less than 10%, rents from personal property, which are leased with real property. So those are, the two kind of main things. But we have to next look at some special rules that apply to those exclusions. So again, we talked about debt financed property, right? So even if it is rent from real property, if the property is debt financed, subject to the exceptions we talked about earlier, then it will become UBTI. The second thing to keep in mind is that if the determination of the amount of rent depends on the net income or profits derived by any person from the leased property, then the exclusion will no longer be applicable. So what that means is if instead of charging the tenant $3,000 a month in rent, they're charged 10% of their net profits, then the passive exclusion for rental of real property does not apply. It's kind of like you're in a joint venture with that person where you're sharing the profits of their business activity. If personal property is rented that is more than 10% but less than 50% of the total rent, then you can carve out the amount of the rent from personal property, which would be like equipment, furniture, any kind of tangible items like that. Then you can carve out the amount that's the rent from personal property, and that'll be UBTI. If, however, the rent related to personal property is more than 50% of the total rent, then all the rent will be treated as UBTI. So you can't carve out the part that is just the real property and exclude that. A very big thing to keep in mind with respect to rental activities is whether there have been services rendered in connection with the rental, which are considered rendered to the occupant primarily for their convenience. So the easiest, way to understand this or to see it is like thinking about renting an unfurnished apartment is sort of different than renting a hotel room, right? I mean, you rent a hotel room, somebody's going to clean the room, there may be room service, there are certain services that are provided to you as part of staying in that hotel room, versus just renting some space and, you do what you do in that space and there's not anybody that's really going to be providing services to you. So kind of The other thing is that some services might be provided that are just for the general benefit of the property. And so that would be like the furnishing of utilities or cleaning, common areas that are not specific to the space where the tenant is staying or the person staying in the hotel room. So common examples of situations where services might be rendered in connection with a rental is when an organization leases space, to a third party for an event, and they provide catering, audiovisual, and similar services, or like event planning services. Aside from operating a hotel, and a university that has, dorm rooms might rent out space for a summer camp. So they might provide classrooms and dorms for overnight stays. And, as part of that, there would be, cleaning, food in the cafeteria. All of those would be services that are connected to the rental agreement. And then lastly, operating a parking facility. So parking has been specifically identified as an activity that does not generate income from the rental of real property. So while it may not, make sense at first, essentially what the IRS has said and interpreted this rule to be is that, when people are coming in and paying you for a specific, spot, and, you have, you're providing, some things in exchange for that, security, et cetera, then it's not deemed to be a passive rental arrangement. So that is the operation of a business, which is parking. And so generally, if you have a parking lot or a parking garage that's open to the public and you're receiving, money from each person that parks there, that is going to be UBTI unless it can meet an exception. So one of the exceptions would be the parking is substantially related to an exempt purpose of the organization. The parking lessens the burdens of government. This is kind of an unusual one, but the kind of related example has to do with an organization that provided parking in an area that was economically depressed, and so private businesses were not operating parking facilities there, and there was a need for it. Generally providing parking wouldn't be considered, government's obligation, but in this case it was. If the parking activity is not regularly carried on, so like let's say, for example, once or twice a year, the organization rents out, or operates a parking lot maybe for a nearby event that's going on where there's going to be parking that's needed. If it's not, regularly carried on, then you can exclude it under that exception. Parking that's for the convenience of members, students, visitors, etc. So like a museum that's operating a parking facility close to its location, so there's a place for visitors to park. That would be excluded as well. Now, you can rent the entire parking facility. So this is where you could potentially have the parking lot fall under the rental exception, and that would be if you rented the entire facility out to a third party. So they're paying you a specific amount of rent, and they're the ones that are actually operating, dealing with the public, and collecting the money for the different spots. So what can get confusing is many times organizations will have an arrangement with a company that provides parking services. They come in, they handle the collection of the money, give them reports on what came in, they pay the expenses for kind of any repairs, maintenance, anything that may be going on. But if that arrangement means that you've just hired an agent, a contractor to provide those services for you, then you're still deemed to be conducting the activity. It would have to be a real lease, like we are leasing this entire, parking facility to you on these days, and you are going to operate it how you want. You'd have to be really careful to make sure that you could meet that criteria. So some tips in dealing with rental income: if you've got personal property that is going to exceed 50%, and it's possible to have separate arrangements to kind of disconnect the items, that would be a recommendation. If you have events like weddings and corporate retreats or things like that, and you want people to use specific people to provide catering or things like that you trust, either in the space or whatever, you could require them. You could say you've got to, pick one of these companies to assist you, but you're going to contract with those companies separately, so that your organization isn't deemed to be providing those services. If you want to base rental income on some kind of contingency, if you base it on gross revenue, that would be acceptable rather than net profits. And then lastly, if you need to provide, or there's no way to have the rental without providing the services that are provided in connection with it, then what you could do is to only engage in rental activities that are related to your exempt purposes. Whether that's the tenant is carrying on an activity that is similar to your mission, or there's some kind of connection to your exempt purposes, then you would fall out of this because it would be a related activity. Okay, we are now to our third poll question, which is, does your organization rent space to unrelated third parties? If so, do you typically provide services in exchange for the rental, or do you not provide services? So what's kind of interesting about this one is sometimes, people don't necessarily think of, hosting events and things like that as being a rental activity, but it can be depending on the arrangement. So it looks like we've got about 90% of people reporting, and we have 40% saying yes and they don't provide any services, 25% saying yes and services are provided, and then about 35% saying no rental activity. Okay, so let's go ahead and close that poll. And let's move on to our last section here. Let me see if we've got any questions on rental activity. Okay, so before we move on, we've got one relevant question here, which is, for an owned, not debt-financed property, we allow a bank to put a driving ATM kiosk in the parking lot. Would this be considered subject to unrelated business income? So that there are kind of similar provisions that come up for a number of organizations where you allow that other organization to put their personal property on your real property. And so usually in those circumstances, what you're deemed to do is just rent real property, which would be the space on which they put their own equipment. So that would typically be excluded under the rental of real property provision. You would have to be careful if you were the one providing the personal property along with that rental, then you would have to consider how those rules would apply. Okay, there's one more question, but let me see if I can get to our last part first, and if we have some additional time afterwards, I will circle back to that. So identifying and allocating expenses is critical if you have taxable income. Of course, you want to try to maximize the amount of expenses that you can deduct from that taxable income. So first, you will want to be sure that you can capture all direct expenses. So it's good to think about the kind of expenses that might be connected to the UBTI activity. So for advertising, direct expenses typically include compensation that's paid to individuals whose responsibility it is to solicit advertising. For rental activities, it can be the depreciation of the assets that are used in the activity. If you're providing services, the cost of that, whether if you're buying the food or you have specific individuals who are providing AV assistance, that kind of thing. You might have an individual who's either their primary or part of their job is to manage the rental events and that, coordinate them and that kind of thing. So you would want to be able to capture that in dedicated accounts. So when it comes time to calculate your unrelated business taxable income, you know what those direct expenses are. But that is just one part of the picture, right? A lot of times the biggest deductions you might have are from allocable expenses. So if you're using a facility for multiple purposes, both in your exempt activities and your unrelated activities, you're going to have a lot of pools of costs where it would be appropriate to allocate expenses between the two activities. But it is important to make sure that you use the right expenses in that pool, before you allocate them out. So you want to make sure that any expenses that are allocated have got some kind of connection to the activity. So for advertising, if it's a periodical, you might look at all, printing costs of the magazine. If it's a website, you would look at, the costs to maintain and design, the design, whatever expenses you might have with respect to the website. For rental, if it's debt finance, you could have interest expense, property taxes, insurance, utilities. And for any kind of unrelated business activity, there's going to be some kind of administrative overhead that would be allocable, like accounting. There has to be bookkeeping done with respect to, the activities, supplies, etc. And then once you've identified the pool of expenses, you want to pick the right methodology. And so you should try to base the methodology on the most relevant metric for the activity or the expense. So if we're looking at employee compensation, you would want to look at what is the time that they're spending on that activity versus their total time. You could also use that for facility usage. How many days or hours of the year is it being used for that unrelated purpose? And you may also, for facility costs, want to take into account square footage. So if you're looking at overall utilities, for the facility, you'll want to apportion it, based on the square footage of the space that's being used for unrelated purposes. And for magazines, of course, you can use pages, how many pages have ads on them versus other information. So let's walk through an example. So in this example, the exempt organization owns an office building, which has a mortgage on it. So let's assume it's the income is debt financed property income. And so what is rented out is the ballroom that the organization sometimes uses in their exempt activities, and sometimes it's rented out. So our example is not going to talk about the debt financed ratio that has to be applied. It's really focused on how do we allocate expenses related to the ballroom unrelated income. So first, I like to look at the fixed costs of the building, and that's going to be based on square footage. So in this example, the total building square footage is 10,000 and the rented square footage is 2,000. So we're looking at a ratio of total building expenses being multiplied by this 2,000 over 10,000. So depreciation, insurance, mortgage interest, we're going to allocate expenses just to the ballroom. And then next, we've got to determine how much of the total ballroom costs are we going to allocate to the unrelated usage. And so this is going to be based on actual days used by the unrelated third parties for non-exempt purposes. Now, the reason I use 365 days in the tax year versus 120, which is the total days that the ballroom is used, has to do with the IRS's current stance on a case that was actually decided against what they had intended, which is Rensselaer. So in this Rensselaer case, the courts found that the correct apportionment percentage was based on using a denominator of total days of actual usage rather than how many days were in the tax year. So while you could certainly use the 120 in the denominator, the IRS has specifically stated that they don't agree with that conclusion, and they will fight against that when they see it again. So the more conservative approach would be 365, but there's certainly an argument for using 120 as a denominator. So for variable costs, we use the 20 days to 120 days because those costs are only incurred when the space is used. So it doesn't make sense to use 365 in that example. That brings us to our last poll question and about the end of our time, which is which allocation factor would be the most difficult for you to quantify for an allocation method? Would it be time spent by certain employees on an activity? I know people don't like to keep timesheets, and many times they don't with respect to what they're doing, unless you're an accountant. Square footage used in a certain activity, or the time certain space is used in related versus unrelated activities. What do you think would be the most challenging to quantify? With about 70% of you reporting, it looks like it's evenly split between time spent by certain employees on an activity, and time certain space is used in related versus unrelated activities. And I think that definitely makes sense because it pertains to records that people are not always cognizant about keeping, kind of what are we doing, whereas square footage is something that is more readily known. All right, so that brings us to the end of our time. I know I didn't get to everyone's questions, but what I can do is reach out to anybody that I missed individually, or you can certainly reach out to me by email if you felt like the question didn't get answered by the content today. And I appreciate you tuning in, and thank you. Have a great day.